Have you ever wondered how General Electric and Honeywell compare in terms of their financial performance? Well, you've come to the right place. We're about to delve into an insightful analysis of two of the world's leading multi-industry corporations. General Electric, a titan of industry with interests ranging from aerospace to renewable energy and power. On the other side we have Honeywell, a diversified technology and manufacturing leader. First off, let's examine the revenue performance of both companies. In the last 3 quarters of 2023, General Electric generated a total revenue of $49 billion, while Honeywell's total revenue stood at $27 billion. Over the past 5 years, General Electric's revenue has experienced a compound annual growth rate, or CAGR, of -6%, while Honeywell's revenue has seen a CAGR of -3%. This indicates a decline in revenue growth for both companies, with General Electric experiencing a more pronounced downturn. Let's delve a bit deeper into the revenue structure of both companies. For General Electric, 48% of their revenue comes from the aerospace sector, 22% from renewable energy, and the remaining 25% from power. On the other hand, Honeywell's revenue structure is a bit more diversified, with 36% coming from aerospace, 17% from building technologies, 31% from performance materials and technologies, and the remaining 16% from safety and productivity solutions. This disparity in revenue structure shows that while General Electric is more reliant on the aerospace and energy sectors, Honeywell has a more balanced revenue stream across multiple sectors. This could potentially make Honeywell more resilient to changes in any one sector. When analyzing these figures, it's important to remember that revenue is just the top line. It's an essential piece of the puzzle, but it doesn't tell the whole story. Profitability, efficiency, and cash flow, among other factors, also play crucial roles in a company's financial health and growth prospects. In summary, both companies have seen a decline in revenue growth over the past 5 years, with General Electric experiencing a steeper decline. However, both companies have strong revenue streams, driven by different sectors. General Electric leans heavily on aerospace and energy, while Honeywell has a more diversified revenue structure. Clearly, both companies have their strengths with different sectors driving their revenues. Up next, we'll take a closer look at their profitability. Moving on, let's talk about profits. Profits are the lifeblood of any business, and the way these two giants, General Electric and Honeywell, have managed their profits over the years is quite revealing. First, let's consider the gross profit margin. In the last 3 quarters of 2023, General Electric reported a gross profit margin of 26%. This is an impressive increase from their 5-year average of 23%. On the other hand, Honeywell reported a gross profit margin of 38% in the same period, also exceeding their 5-year average of 34%. Now let's delve into the net profit margin. General Electric reported a net profit margin of 16%, a significant improvement from their 5-year average of -4%. Similarly, Honeywell also reported a net profit margin of 16%, consistent with their 5-year average. Looking at net profit over the last 5 years, we see some interesting trends. Honeywell's net profit for the last 3 quarters of 2023 was $4.4 billion, closely aligning with their 5-year average of $4.2 billion. General Electric, however, experienced a dramatic turnaround. Their net profit for the same period was $7.6 billion, a stark contrast to their -$22.4 billion in 2018. While Honeywell's net profit has remained relatively stable, General Electric's has seen significant volatility. From a massive loss in 2018, they have managed to turn the ship around and report substantial gains in 2023. In a nutshell, both General Electric and Honeywell have demonstrated strong profit margins. However, the journey to these profits has been markedly different for each company. General Electric has shown a tremendous turnaround, while Honeywell has maintained a steady course. Both approaches have their merits, and it will be interesting to see how these strategies play out in the future. While both companies have shown significant profit margins, their paths to these profits have been quite different. Now let's take a look at their assets. Moving forward, let's delve into the asset analysis of General Electric and Honeywell. As we analyze their assets, we'll uncover a wealth of information about the financial health and operational efficiency of these two industrial behemoths. As of the 3rd quarter of 2023, General Electric reported total assets of $157 billion. Quite a significant figure, isn't it? On the other hand, Honeywell posted total assets of $61 billion. A smaller figure, yes, but still substantial in its own right. But here's where it gets interesting. When we examine the net assets of each company, we find that General Electric's net assets stand at $30 billion, while Honeywell's net assets are at $18 billion. Now you might be wondering, why are these figures important? Well, they provide insights into how each company is managing its assets. It tells us about their ability to generate profits from their assets, and how efficiently they can manage their liabilities. Let's take it a step further, and look at the equity to total assets ratio. For General Electric, this ratio stands at 19%, while for Honeywell, it's 29%. This ratio is a key indicator of financial stability. The higher the ratio, the more financially stable the company is considered to be. It shows that the company is able to finance its assets through equity rather than debt. In this case, Honeywell's higher ratio indicates that it has a more significant proportion of its assets financed by equity. This could potentially mean that Honeywell is at a lower risk of financial trouble, as it relies less on borrowed money. It's crucial to remember, though, that these numbers are just a snapshot in time. They can and do change based on a multitude of factors, but they do provide a solid basis for understanding the asset management strategies of these two companies. These figures demonstrate how each company manages its assets and equity. Next, we turn our attention to operational efficiency and cash flow. Operational efficiency is vital to a company's profitability and longevity. It's about how well a company uses its resources, and how quickly it converts inventory and accounts receivable into cash. To gauge this, we look at several key metrics. For General Electric, the current ratio stands at 1.17, and the quick ratio at 0.82. This suggests a reasonable liquidity position. In comparison, Honeywell boasts slightly higher figures with a current ratio of 1.35, and a quick ratio of 1.01. When it comes to inventory management, an important aspect of operational efficiency, General Electric takes around 120 days to sell its inventory, while Honeywell takes a slightly shorter time of 93 days. In terms of collecting payments, General Electric takes approximately 82 days, slightly longer than Honeywell's 76 days. Now let's talk cash flow, the lifeblood of any business. Over the past 5 years, we've seen different trends for these two giants. Honeywell has experienced a gradual decline in operating cash flow from 2018 to 2024, while General Electric has seen an increase in the same period. When we look at free cash flow, which is the cash a company generates after accounting for capital expenditures, we see a similar trend. Honeywell's free cash flow has been slowly decreasing over the past 5 years, while General Electric's has been steadily increasing. Lastly, we consider the operating cash flow to net income ratio. For General Electric, this stands at 0.3, while for Honeywell, it's at 0.5. This ratio gives us a sense of how much cash is generated from business operations relative to net income. These numbers provide insights into how effectively both companies manage their day-to-day operations and cash flow. Finally, let's do a DuPont analysis to understand return on equity better. The DuPont formula breaks down return on equity, or ROE, into 3 components: net profit margin, asset turnover, and asset to equity ratio. For the third quarter of 2023, General Electric posted an ROE of 34%. This was comprised of a net profit margin of 16%, an asset turnover of 0.37, and an asset to equity ratio of 5.25. In contrast, Honeywell's RO was slightly lower at 33%, with a similar net profit margin of 16%. However, Honeywell had a higher asset turnover at 0.59, and a lower asset to equity ratio at 3.45. This analysis illuminates the different strategies and outcomes of General Electric and Honeywell, informing us about their financial health and performance. Stay tuned for more financial comparisons, and remember, knowledge is power in the world of investment.